Hey everyone, this is Jackson Millan, the Wealth Mentor, the co-founder and CEO of Aureus Financial.
G'day, Sam Panetta, COO and co-founder of Aureus Financial.
And we're here again for another episode of Ask Aureus Anything live Q&A. We've had some really phenomenal questions throughout the last week. I can't believe the week's already gone. It's just...
month's already gone. January's done.
Disappeared before our eyes. So we're here again, answer your questions, hit us with them live. And we will work through them. Otherwise, we have a list of questions that we've got throughout the week. We picked up from our client meetings and from you guys on social media, which we're going to work through today.
Also, a couple other things. We're looking at changing the time of the Ask Aureus Anything. We've had a little bit of feedback. Maybe 1:30 p.m. is not the best time for everyone. We still want to get a little bit more feedback because we've had a couple of different times. So if you have any thoughts on that, feel free to get in touch with us and just let us know what times do suit you guys best, when are we going to be able to add the most amount of value. And second of all, this is all general advice. Don't action anything that we say without consulting a professional first.
Yep, a couple of announcements as well. We still have some spots available for our free small business workshops on the 17th of February at our Brookvale office. We're covering the $1 Million Mindset, working out how to build your strategic roadmap in your business, having a chat about your 90-day plan for you to achieve success both personally and in your business. And really working on the implementation aspects of you achieving your goals, both personally and in your business. So normally we do charge for these events. We're just trying to add value to the network for our first one to kick off the year. Limited at 24 seats. So if you're interested, feel free to reach out to us and we can book you a seat. It's going to be from Saturday, the 17th, from 9 a.m. to 5 p.m. It's going to be a pretty intense day, but there's going to be a lot of learning. So I'm sure you'll enjoy. Also, my book's been doing really well on Amazon, so thank you for all of you that have supported. I really appreciate it. I hope you've been getting value out of it. I've got a bit of feedback so far, which I'm really pumped about. It seems that people are really enjoying the content and working through the activities. If you have downloaded the book, make sure you register for the learning portal. We know that a reading experience isn't always the best way to learn for most people. So I created an online portal which has videos, workshop activities, cheat sheets that will help you work through the book and actually start implementing. The reason why you're still looking for education is because what you've done so far probably hasn't worked. So if you're going to use this as an opportunity to address the gap in your situation, take it seriously, implement. I've built all the tools for you to do it. So for those who haven't bought the book, it's 99 cents, you cheap bastards. Go buy a copy.
Buy 2 copies.
Buy 2 bloody copies. Give one to your mother-in-law for her birthday. I don't know. But we'll dive right in. So, kicking off, is there a minimum amount of money that you need to feed into a share portfolio after the initial startup costs? Okay. There's a bit there. I've spoken about this a couple of times in these Q&As and in other things we've done. I don't advocate that our clients buy direct equities. Just don't do it. Think about it. There's so many different companies out there. You've got Australia only takes 2% of the global market. And even if you look at the ASX 300, there's 300 companies there that are changing every single day, implementing different strategies at different levels of their growth trajectory. How do you know which one to pick? And for most people, it's very scary to think about that process of selecting the right stocks. And for most people, they end up becoming punters. They're just rolling the dice. That company looks good. Oh, cool. I've seen that one on the news. I've heard somebody speaking about that, and they dive in, and obviously they're leaving things to chance. Don't do that. I advocate utilizing an index passive style approach where you can get huge amounts of diversification across the entire world, where you can choose one index fund that has exposure to every single index in the world. We typically use a provider called Vanguard. Vanguard is the largest manager of passive investments in the world. Now, you can get access to a Vanguard investment for as little as $1,000. Similarly, there's other things that are out there like Acorns. I personally use Acorns myself, which is a micro investing app. which allows you to link it to your bank accounts, and it actually rounds up your transactions and invests in a very similar way than what Vanguard would do into index style investments. So you can start with $1,000. Getting started is just where you start. What makes the difference is how you continue to contribute. So yeah, that's an important part. I advocate set up an automatic contribution to your investments on a monthly basis, or if you get paid on shorter frequencies, on the day that you get paid, pay yourself first, get started in getting money into the market. It's about taking action. Don't try and save up a huge sum of money to get it into the market. Just start doing it.
Yeah, and I think for those who don't know what an index fund is, it's essentially a fund that invests small amounts over a large group of stocks. So let's say the ASX 200, there's 200 different shares or businesses in the ASX 200. Instead of trying to pick which ones are going to outperform and roll the dice on that, you buy the index. So essentially buy shares in the index, and the index invests a little bit in all those 200 companies. So you're instantly diversifying yourself. The bet then becomes less on will one company do well, and it becomes more, will the Australian economy do well, will the world's economy do well over time? Yes, it will, it is fine.
I was doing some research recently about the ongoing performance of any particular portfolio going back to the 1900s, depending on how much allocation you put into defensive investments and how much you put into growth investments. And we typically work in what we refer to as a risk profile, ranging from conservative all the way up to high growth. And that typically is depending on how much percentage of your overall money goes to growth investments. Now, even in the most high risk portfolio, meaning that 100% of your money was in growth investments, since the 1900s, only 1/4 of the time was the market producing a negative return in any 1 year, which effectively means that the longer that you can wait, the compounding is able to basically provide you with a substantial return. And the average return has been around 10% for accumulating the index. The average return of a retail investor, however, has actually been about 3%. And that comes back to my first point: people are punting. They are trading too often, they're picking losers, they're crystallizing losses, and they don't really understand the language of money. So diversify and control what you can, which is how much you can contribute.
Very good. All right, so question number 2 today. They have asked us, once you take out a home loan, is it better to put money into the offset account or to look at other investment opportunities? This is a great question. Absolutely great question. So I guess it comes back to what your goals are. I guess to explain before I get stuck into it, an offset account is essentially a transaction account that's linked to your home loan that offsets the amount of interest that you pay on your mortgage. To give you an example, if you have a home loan of $500,000, you have an offset account that has 50 grand in it, then essentially at the end of the month, you'll only be charged interest on 450,000, which is your total amount of debt less the amount of cash that you've got in your offset account. So essentially, if you had 50 grand in an offset account and your interest rate on your home loan was 4.5%, you're saving 4.5% on your money, or your money's earning 4.5%. So when you look at whether your spare cash should be sitting in an offset account or if it should be invested in other opportunities, you need to ask yourself what it is you're actually trying to achieve. So we advocate always having a cash buffer in your bank accounts. Maybe it's 10 grand, maybe it's 20 grand. And from there, that's sort of the minimum requirement of the amount of cash you need to hold at all times. From there, you need to work out, are you saving towards a goal? So are you saving to buy a new car or to buy a home, or what are you trying to do? So let's give it 2 scenarios, all right? Let's say that you're saving to grow your wealth and you want to buy another property. I'd probably be saving that cash in your offset account because it's a risk-free return of about 4.5%, which is pretty good. And it's no chance you're going to lose money on it. The more money you stick in the cash, more cash you stick in the bank account, the more money is going to be there when you need the money for the deposit for your home, for your next property. On the flip side, let's say that you aren't looking to accumulate any more property, you're not looking to accumulate any cars or any short-term saving needs, then you could think about investing that money instead of putting it in your offset account, investing it in index funds, as Jackson was just talking about, and growing your wealth that way. Over time, index funds, as Jackson mentioned, perform at about 10% per annum, and they'll pay dividends and things like that as well. So over time, an index fund will outperform your offset account, but it will do it with more volatility. So it'll go up and down. That's how share markets work. So if you didn't need that money for 10 years, I'd probably be sticking it in more aggressive assets such as index funds and shares.
The other thing you got to be mindful of, whether it's your home debt, meaning that it's a non-deductible debt, or whether it's an investment property debt. Because the other consideration is your tax. And I did a scenario of this in my book, which kind of paints a picture of what this actually looks like. And we need to consider an interest paid to the bank needs to be considered in the same light as an interest earned or a return that is earned. And we need to consider that when we make a return on our investment, we need to consider the tax. So let's say if we do make a 10% return and our average tax rate is 30%, we're actually only going to get 7%. Whereas if we are paying the bank 4% on our home, and that's money that we actually had to earn, pay tax on to then pay the bank in after-tax dollars, that's equivalent to around about a 7% gross amount that you had to earn in order to pay the tax to pay the bank. So you effectively need to measure that for any investment that you choose compared to putting money in the offset against your home that's non-deductible, needs to return in excess of 7% net in order to be a better investment for you. And in saying that, putting money in the offset is a gross 7% guaranteed return, because it's essentially money that you're not having to pay to the bank. Because the bank's always going to come knocking for their interest, whereas the share market could tank tomorrow. So once again, it's about utilising these tools and this education to reframe the way that you look at these strategic decisions in your life, and ensure that you're constantly trying to get the best possible outcome for the level of risk you're prepared to take.
Comes back to having a strategy.
Correct. Cool. Oh. All right. So the next one is, and thanks for the feedback, Andrew. Any questions, mate? Feel free to chuck them up. There's no such thing as a silly question. So what are the main differences, if any, for investing in property interstate? There's a couple of parts to this. I'm only going to scrape the surface on the basis that I'm not a property expert. I understand the ways that we go about utilising property as an asset class to build wealth, but I'm not living and breathing property every single day. In saying that, we're actually doing a podcast after this, which is probably going to be released in a couple of weeks' time, with a property expert that has assisted clients with accumulating hundreds of millions of dollars in property. So we'll be picking his brain. What I am going to say is that typically at every peak of the market in Sydney and Melbourne, spruikers come out of the woodworks. I get contacted probably 2 or 3 times a week on LinkedIn for people trying to sell me off the plan property for me to try and push it onto my clients. I had an incident the other day where this guy sent me a message saying that he was a developer and he had all this stock that he wanted to get rid of, and he wanted me to offer it to my clients. I basically told him where to stick it quite politely. I said, sorry, I don't work with developers or spruikers. And he actually got very, very defensive about that, saying, we're not spruikers, we do good things, blah, 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 blah. And I go, look, listen here, you don't need to get defensive. A spade's a spade. You're either a developer or you're a spruiker, or you're a developer and a spruiker. So you need to be careful where you get your advice from. Buying interstate is obviously, you don't have a home bias. For example, if you're living in the Northern Beaches, or you're living in Perth City, or wherever it may be, you understand that there's certain areas that aren't desirable. There's a housing estate somewhere over there. There's a methadone clinic, or there's a train that goes past here with coal trains. So you have a little bit of insight around the micro factors. So that gives you a little bit of an advantage. But ultimately, when it comes to selecting property, it's about getting the macroeconomics right. It's about understanding the measures in which drive property prices. So there's essentially there's supply and there's demand. Demand is generally driven by how the economy is going and essentially the growth in household income. There's infrastructure and understanding whether there's people that are providing and building things that are keeping people there and giving them quality of life. There's access to jobs, of course. And essentially all of these things will influence the supply and demand characteristics of a particular market. So what I recommend to you is that if you're buying property anywhere, you should be getting advice from a professional who is doing it objectively for you, that you are paying a fee for. Be very wary of getting advice from people who are receiving a commission from a developer, similar to the scenario that I mentioned before, because you've got to, if somebody's getting paid by somebody else, who are they working for? The person that's paying them. So you need to be very careful with that. There's so many ways to go wrong with property, so it's important to get good advice. Hopefully that answers your question.
Yeah.
In saying that, I've got interstate property, and it's because I did the due diligence and I got advice around that, and I was able to make that decision. You as well, Sam?
Yeah, I've got interstate property myself, and I don't mind investing interstate. I think it's, if it suits, I don't think it's a bad idea at all. Number one thing that I say to people, as Jackson mentioned, is you have to get advice, right? If you're looking at buying your home and it's in the suburb that you grew up in, you know the area, you know what's going on. If you're looking at buying a property in if you're based in Sydney and you're looking at buying a property in Brisbane or somewhere in Victoria or Adelaide or Hobart, it doesn't matter where. If you're not getting paid professional advice to help you select that asset, you really don't know what you're doing. You're winging it. You're punting in the dark. So yeah, if you're going to invest interstate, which I don't think is a bad idea, get advice for it.
And there's a follow-up question here, and thanks for that, Andrew. The best option for looking at buying your first home. You're looking to get in at the lower end of the market, around 300 to 400K. So you're just looking to start off with something, get your foot on the ladder, and start paying that off instead of obviously paying someone else's mortgage, which is a great question, and it's very common. I'd say that getting your foot on the ladder is always the hardest part of building wealth. But you need to be important that you're not just scraping in at the bottom of the barrel. You need to understand, are you buying a good quality property that is desirable from a supply and demand perspective, and that ticks all those boxes around the macroeconomic principles that's going to drive property growth? For example, and Andrew, I know that you're from Perth. Perth had a phenomenal growth in terms of the property market, because it was very closely linked to the resources boom. But because it didn't have a very well-rounded economy, of course, there's other economies and other contributors in terms of GDP in Perth, but it's just really overwhelmed by the resources sector. When the resources sector took a dive around that 2012 mark, the market just hasn't recovered. Unemployment skyrocketed, vacancy rates in turn have skyrocketed, which means that the supply for the level of demand is out of sync, where the reason what's happened in Sydney and Melbourne is it's the opposite way around. It's that there's not enough supply for the amount of demand, which pushes up prices. So my advice to you would be, make sure that if you are buying a property, that it is in an area that is desirable and has the macroeconomics to support its future growth. And if you are looking to buy in Perth, although there's commentators that are saying that Perth is near or at the bottom of the market, you cannot expect to get immediate growth. But I say get a foot on the ladder as long as it's a good quality property. Start manufacturing your own equity by paying it off, and just be willing to wait. This is a long-term investment. Be willing to wait at least 10 years and to let compounding work its magic from then on out. Once again, if you want to have a bit more of a chat about that, we can take it offline and dive into that in a bit more detail.
Yeah, and I think I'd also like to chime in on that one, Andrew. I think you're talking about buying your first home here, so it's you need to segregate between the investment part of this and the home part of it. Because it becomes an emotional decision then, and when you're buying your first home, you're not going to go interstate and go buy somewhere else because it's a better investment opportunity. You need to buy somewhere where you want to live in, somewhere that's going to be your home. So you need to weigh up those pros and cons. Ideally, you find something that's going to be a really good home and something that's going to be a really good investment as well.
Yeah, that's a good point, mate. If you look at this property and I guess at this 300 to 400 grand is just a stepping stone, you've got to consider that just to have the ability to start renting that property from the bank, because that's in fact what you're doing when you're taking on a mortgage, that you need to recover the stamp duty and purchase costs along with the future sale costs before you're at a break even. So if you're using this as a stepping stone and the market doesn't in fact grow during that time that you're willing to jump to the next stepping stone in your wealth journey towards the kind of dream home as such, then it's actually not going to be a good vehicle for you to continue to build your wealth. It's only giving you that sense of fulfillment that you're paying off your own property as opposed to somebody else's. So it's about, as Sam said, make sure you get the balance between what is an investment and what is a lifestyle decision right, because that will guide you in making the right decision.
Yeah, and on that, for when you buy a property and then you pay the stamp duty on it, and then when you go and you sell it and you've got to pay the selling costs, that's not going to be any less than 7%. Do you know what I mean? So that's essentially, if you buy a $500,000 property, you need to sell it for $535,000 at a minimum just to break even. So the property's gone up in value, but you've still lost money on it because of the transaction costs. So if you're looking at doing this for a short-term thing, you really need to crunch your numbers. If you're going to buy this home and live in it for 10 years, then that's a little bit of a different story.
Yeah, I'll give you a bit more context just before we move on. Even for myself, and I was in a similar boat. Obviously, we're on the Northern Beaches. Property here is very expensive. The house that I want to buy is probably $2 million. I don't have the means to buy that right now. So I'm using investment property as a vehicle to allow me to continue to build and compound my wealth, to then consolidate that later on down the track when the city market has gone through its kind of correction phase of sitting flat, which typically goes for around about 5 years. So that is going to allow me to continue to build my wealth in an investment, which I have no emotional attachment to. I'm just positioning as a vehicle, which is going to allow me to build a sizable deposit to ultimately come back and buy my dream home within the next 5 or so years' time.
Hope that's helped you out, Andrew.
Alrighty.
What do we got next? All right. Pretty simple one. They've asked, how can I improve my credit rating? All right, so your credit rating is not so much about improving it, it's about not damaging it. So let's talk about some things that really damage your credit rating. If you default on a debt, that's pretty bad. If you claim bankruptcy, that's really going to destroy your credit file. If you make too many inquiries on certain types of debt. So if you make any inquiries on what they call payday lenders, so these are the small loans that you see on the TV, they're $500 or $1,000 or $1,500, and they charge you 20%, 30% interest rates on. If banks see that you've gone for loans like that, then that's going to negatively affect your credit rating as well. Also, if you've had too many hits on the same thing on your credit file. So let's say you keep trying to go for credit cards and keep getting knocked back, or personal loans or car loans, then all those sorts of things show behaviour that is not, I guess, congruent to someone with a strong credit history. Also, if you have phone bills or utility bills that you don't pay, then that'll damage your credit file as well. On the flip side of all of that, sometimes mistakes are made, and we actually have contacts in the industry that can go in and bat for you and have errors removed from your credit file. So, let's say that you've moved overseas and there was some Optus bill that got forgot about, and you defaulted on it over $30 because you didn't even know it existed. You might be able to move that around. If you had a $10,000 credit card that you defaulted on because you just didn't want to make the repayments, then that's really going to damage it. On the flip side, a lot of people talk about, how to improve it. So make all your repayments on time. Don't inquire for credit when you don't need it. We touched on that last week. Don't shop around with lenders when you're looking for a home loan. All right, this is what I see. Some people do. They're trying to get a best rate, and they go into every single bank branch on the strip, and every single bank hits their credit file, and by the time I pick it up, I look at it, they've gone for the same loan 10 times with 10 different banks, and no one wants to touch them anymore because it looks like every single bank in Australia has declined them. So don't do that. Go to a mortgage broker who can do all the research without hitting your credit file, and then pick one lender and then move forward from there. And that will actually improve your credit file, because for someone who has the means to save up a deposit, get a home loan and buy a property, that's actually a positive sign on your credit file, because it shows that you've got the discipline and the means to earn, save and buy a home.
Good advice. Awesome. All right. What do we got here? Okay, this is actually a question that I got earlier today. I'm considering moving overseas and working as an expat. What should I do to ensure that my finances are on track? So there's a couple of parts of this, and particularly in this conversation that I had was going to a part of the world where there's much more favourable tax concessions than in Australia. And this goes both ways. To give you an example, I've had clients that have moved to countries that have low tax, like for example, Singapore, or I've had countries that have moved to high tax, like Belgium and some areas in Europe. So ultimately, you need to look at how do you compare the Australian tax system to the tax system in the country that you're going. It's about getting really good expat tax advice and understanding what's actually going to work out more favourably for you, particularly as most expats, when they go overseas, make a lot of money because you're going there for a reason, right? You're not going to just pack up your life to go sweep the streets or something like that. You might if you're getting paid enough. So in any case, you want to make sure that you understand that. Then it's about establishing a business case. It's about understanding, well, what are the circumstances which would make you a tax resident of Australia, even though you are overseas, or vice versa, not be a tax resident of Australia if you were in a country that was more favourable. And with all of those things being considered, then it allows you to make an objective decision around how you go about that and get the right tax advice for somebody to liaise with the ATO on your behalf to essentially ensure that you can be established as one or the other. We typically find that a lot of expats will go overseas for a period, whether it be a couple of years or whatnot, and then come back and resettle their lives in Australia. So there can be some very significant implications depending on how you approach that from investing. Particularly if you're looking to buy property, either have existing property or wanting to continue to buy property whilst you're overseas, and other things like that. So to summarise, make sure you get the right advice, and it's really just a matter of comparing to make sure that you can find the most favourable outcome for tax.
And I guess this is a really niche area, so most people aren't going to benefit from this advice. But if you do fall into this niche, you absolutely need to nail this. It's super important that you don't get this wrong.
Yeah.
Okay, so we have another question here that came in after last week's Q&A session. As the Sydney property market keeps growing, is it still a viable investment opportunity, or should you look interstate or at a different investment altogether? All right, there's a few questions here, so I'll do them one by one, okay? So as the Sydney property market keeps growing, is it still a viable investment opportunity? Over the long term, yes. Over the long term, Sydney is going to do absolutely fine. It's a global city. It's an international city. It is the biggest city in the country. It's the finance capital of Australia. It performs perfectly. The economy does really well for many, many years. Will continue to do well in the future. People get wealthier and wealthier over time in Sydney. The population continues to grow. So over time, I think Sydney is going to be just fine for a property investment. At the moment, it's slowing down. The stats are starting to come through, on the ground in real time. I'm starting to see clients of mine and associates of mine who are noticing that the property prices are coming off. How long that's going to be the case for, I have no idea. But over time, yes, Sydney will be just fine as an investment opportunity. Should you look interstate, as we touched on before? If it fits in with your strategy, then yes, you should look interstate. You shouldn't restrict where you invest to the 5 suburbs surrounding where you grew up in your parents' bedrooms. You know what I mean? If you need to spread your wings and look interstate, yes, you should do that. If you do that, you need professional advice because you don't understand the area, the demographics. You don't understand any of those things. So pay someone who knows what's going on there. The third question's a different investment altogether. Look, it all comes back to having a strategy. So what are you trying to achieve? It's if you don't have your end goal in mind, then no investment is going to be right. And that's one of the main things that we need to try explain to people when they come here. Most people that come to us, they go, Sam, Jackson, what's the best investment I can make? Well, I don't know, mate. I don't know anything about you. I don't know what you're trying to achieve. I don't know where you are today. Let's work out where you are today, where you want to get to, and then we'll pick an investment to get you there. So if your goals and demands a different strategy and it demands a different asset that's not residential real estate, then of course you should look at it. But you won't know unless you have an end goal and strategy in mind first.
Yeah, this is an interesting point, and this is one of the issues that I have with the barefoot investor. And I really like Scott Pape and what he has to say. And it was #1 book that was sold last year. I think he sold 400,000 copies, which in my opinion is not enough. I think in a country of having a population of our size, there should be more people investing in that education, but that's another topic altogether. But Scott doesn't believe in investment property. He made a few case studies in his book where he spoke about the growth of property in areas like Amsterdam and whatnot over, his property's been there for hundreds and hundreds of years. And he goes in, when he's trended the performance of those properties over the long term, that the returns have been actually under inflation. They go, well, that's great, Scott. Go put some shoes on, mate. But you've got to understand that coming back to the macro factors, if there's an abundance of land and if there's an abundance of resources, then the relationship between supply and demand isn't in a way that will drive growth. And as such, where there's a little drive for growth, property's not going to move. If there's an oversupply of property and there's no demand that's going to take on that supply of property, then the property prices aren't going to go up. It's very, very simple. It's simple economics. So we are seeing right now that in across Australia, in most metropolitan areas, I'm sure you've probably seen there is cranes absolutely everywhere. And that does present a short-term risk. But we need to understand that Australia is a very desirable place. We're not living in a third world country where people there's 30% unemployment. We have low unemployment, there's a lot of opportunity. There are going to be times where the economy does it tough, but given our diverse range of employment sectors, the risk has been minimised. So therefore, there's always going to be long-term drivers for property. So people always need a place to live. People want to live here. It is a lifestyle destination. It's not a necessity. So as long as you're buying blue chip quality property in desirable areas, not in Bonnie Doon, or in the sticks somewhere, Kickatinalong or something like that. I heard that somewhere in North Queensland. Then you'll be all right. Just don't expect to make a quick buck. Don't speculate.
Yeah, and to touch on that, we spoke about this last week as well, right? So property as an asset class in a country, it performs well. It needs two things, okay? It needs the wealth of the country to grow, and it needs the population of the country to go up. You can't have one without the other. Property won't grow. In Australia, we have a very long history of the wealth of the people going up and the amount of people coming to Australia, migrating, plus natural, births and all that, pushing the population forward. So as long as you see the wealth of Australia doing well and you see the population of Australia doing well, which people want to come into a desirable country, then you'll see residential real estate do well as well over long periods of time.
Awesome. Lots of property questions. It's a sexy topic.
Australians absolutely love property. They love it. Absolutely.
Next one. All right. We're not going to talk about property. So how do I create a business plan, and do you have a template? I have very strong opinions about a business plan. I believe that a business plan is used in its traditional sense for two purposes: to go get money from a bank or to raise capital from investors. As a means of guiding you on your business journey, it's not an effective tool. It's a static document, and given that it is going to be a very robust document, like our business plan is 60 pages.
It took a while to put together.
It takes a long time to put together, and given that it is so significant, it is realistic in the complexity of business to be able to constantly update it. In saying that, I do believe that you need to have an action plan in your business, and the way that I like to approach this is having a 90-day plan. And a 90-day plan allows you to get very clear on your vision and your mission and really your purpose in business. And it's about repositioning yourself as an entrepreneur and repositioning your business as a vehicle to allow you to exercise your pursuit of your purpose. So once we're able to do that, it's a matter of reverse engineering that exercise down into a measurable action plan with really simple and straightforward steps that you can follow on a day-to-day, week-to-week basis to give you guidance 90 days at a time. We typically try and diarise time on a weekly basis to work on our business, whether it be a number of aspects. And I believe a lot in self-assessment. Through going through that tactile process of filling in all of the gaps of your 90-day plan and having all of that, it's about self-assessing where you are going in each pillar of your business. And more importantly, how the success or, your need for support in certain areas of your business has an impact on your personal life. So we've created what we call the wheel of business, and the wheel of life. And we do that concurrently to see the relationship between your, I guess, the levers you can pull in your business and the impact that has on ultimately how you're living your life. Because if you're creating a business, which is just creating a job for yourself and you don't have a life, you're slaving away, you're working 6 days a week, you're working 12, 15-hour days, you feel guilty and torn between your family and your business, you are not in the right business, or you haven't structured it appropriately to give you the life that you desire. We are business people on the basis that we want to craft a life for ourselves of abundance, and we want to have flexibility to do the things that we enjoy, which we cannot do under the grasp of the man. So therefore, you need to ensure that you've got the right plan in place to support you on your journey to achieving that. So yes, we've got some templates. We will be going through a lot of that in our small business workshop on the 17th. Thanks, Sal. Sal's posted up some information around what we're going to cover in there and the link for registration. As I said, it's free. Come along, 24 seats, and you will get a phenomenal amount of value. You'll get access to these templates, and hopefully it'll set you up for success for 2018, but hopefully many years to come.
I think this stuff's really important, mate. I think this is a big part of what we do, especially with all our business clients. It's when you're an employee, you really need to worry about your job, and then you need to worry about your personal growth, your wealth journey, and all of that. When you're a business owner, there's a whole other dimension to it, because you need to worry about the business as well, and then that feeds back into your personal growth. And you have to put more effort into it as a business owner. You need to work out what you want personally. You need to work out what the business needs to do. And if you don't do it, you're not going to get the results that you want. We see there's two big differences with business owners, right? We see guys who have absolutely crafted the life that they wanted, and they use their business as a vehicle to do so. And we see other people that are complete slaves to their business and typically really shouldn't be in business at all, because they're making life harder for themselves rather than easier. So that comes back to planning.
Yeah, I went to an event last night with Kerwin Ray, and I'm sure a lot of you that are watching this either live or in the recorded version know of Kerwin and his kind of thought leadership initiatives in the business space. And he's a pretty funny bloke. I'm pretty sure he dropped the F-bomb about 1,000 times last night. It was phenomenal. And he was just carrying on like a raving lunatic, but it was really inspiring. And he was one of the only business thought leaders that calls people out on their bullshit. And one of the statements that he said that was really profound was that he basically said, by show of hands, who of you have bought a business, self-help, or a finance book before? Basically, most of the people in the room put up their hands, and then he screamed at them and said, well, why the fuck are you here? You know everything. You should be successful already. And it's because people love to learn. They love to learn new things, but they're not willing to put in the work that's required to implement. As I've mentioned throughout all of this, taking action is the catalyst for change. You ask any successful entrepreneur how they became successful, and they'll tell you either one or two words. Work, hard work, actually, yeah, three. We'll say three words, or fucking hard work. So you choose one of those, and you'll be successful too.
I hope that answers your question.
Kerwin's rubbing off on me and dropping F-bombs.
Oh, no. All right. So this is something from last week. Jackson and we kept talking about compounding. All right, compounding is a beautiful thing. It's the seventh wonder of the world, compounding. I could see the blank stares through my laptop. Absolutely no one understood what compounding is. So compounding is when you earn interest on interest already earned. Okay, so in the short amount of time and with smaller numbers, that's not that exciting. But over bigger numbers and longer amounts of time, it's very exciting. So let's look at, you started off with $1 million and you earn 10% interest on that in the first year. You're going to make 100 grand, okay? Let's assume that you've got 1,100,000 now in this investment and you earn a 10% on that amount. The second year, you're going to make 110. No, you're going to make 100 and you're stuffing up my things.
Sorry, mate. I did an example of this at a very high level that is going to really drive it home. Did you want to go through it?
Yeah, where is it? Let's bring it up.
So this was an example, and I actually stole it from Tony Robbins' book, Unshakable, and it's fantastic. We tried to illustrate the comparison of compounding in two real-life scenarios for two people called Joe and Bob. So basically, we talked about the contributions of these people that have made to the stock market. Using that previous example of around about 10% compounding per annum, and basically between when they start out on their wealth journey at 19 to the age of 65, or what they end up with.
Mm-hmm. You can go through this. You put all this together.
So Joe and Bob. So Joe starts at 19. He contributes $300 per month, each and every single month until he turns 27. So in total, he's contributed $300 a month for about 8 years. It's just shy of about 30 grand. And we've got his friend Bob, who doesn't start until 27, but he keeps contributing each and every single month from 27 until he turns 65. Now, rhetorical question, but what do you both think each of them have at 65? And which one do you think has more, given that Bob's contributed for a very long amount of time? So Joe has 1.86 million at that point in time, assuming 10% compounding per year, assuming he had all his money in the share market. And Bob only actually has about 1.58 million over that time. So although Joe has contributed substantially less, just because he started earlier, 8 years earlier, he was able to have 273,000 more. Now, let's go take it to another level. If Joe would have kept contributing $300 a month from 27 to 65, he would actually have $3.45 million at 65. So it's a total of 1.86 million more than Bob, which is crazy to think about.
Yeah, and this concept of compounding, of earning money off money already earned and continuing to do that over long periods of time. That's what it's what allows people to become very, very wealthy. And that's what's kept, wealthy families wealthy for so long, because it gets to the point that their assets are doing all the hard work. You need to think about it. If you had, let's say you've got 10 grand in the bank and you make a phenomenal return of 50%, all right, on a $10,000 investment, you're going to make 5 grand, which is really good, okay? If you had 10 million in the bank and you made a 5% return, you're going to make 500 grand on your 10 million.
Yeah.
So the comparison of the returns are horrible, right? But because the numbers are so much bigger, you've made so much more money. And that's the whole point of compounding, is to reinvest the money that you've already earned from your investments. And over time, as you can see, that's what does all the work. The money, that's capitalism. The money does all the work, not the person.
Yeah. And it's one of those things that you have to have money to make money, and that's really the essence of compounding.
And that's where that saying comes from, mate.
So, sorry to hijack your question. You're right. All right. So what's the best way to save for my holidays without smashing my savings? How do you do this, Sam, when you save for a holiday? What do you do?
Oh, mate, I'm a wog. I'm pretty good at saving.
You're one of the best savers I know.
I'm very good at it. I essentially, all right, this is how I do it. So I have an account that all my money goes into, or my wife's money goes into, all our rent from all the properties goes into one account. All our expenses come out of that account, and I've got a running budget, right? So I know how much I can save, or assume that I can save every month, all right, based on my budget that I have. So that money at the start of every month, what I want to save, I take it out straight away. Before anything else happens, I take out the money I think I can save and I put it into a savings account. And that's essentially how I save up for anything.
You pay yourself first.
Pay myself first. Before, if I run out of money, I run out of money, too bad. But my savings are the first thing where the money goes.
Yeah, and it's, I guess, one of these things that people get this wrong a lot of the time. And for a couple of reasons. They don't pay themselves first. And for a lot of people, they don't have the transparency or the discipline that Sam has to stick to that amount. So what I find works for a lot of clients is that if you're still just learning how to manage money, you're not very disciplined in regards to your savings, I believe that you should have a bucket that has a specific purpose. So for a lot of my clients, I have them establish an annual bills and a holiday savings account. And we say, okay, well, how much do you want to spend per year? Is it 10 grand, 15 grand, 20 grand, whatever it may be? And it's about saying, okay, well, fantastic. Let's break that down into a monthly contribution that needs to go into that account. And essentially, religiously, we set up the automatic transfer that as soon as you get paid, you're paying yourself first, and that money's going in there for that purpose. And then essentially, it's about saying, well, okay, once it builds up to the level that you're able to book your flights, go book your flights. Once it's saved up to a level for you to pay for the accommodation, you pay for the accommodation. And then essentially, once it's saved up to a level that you've got your spending money, then hopefully you go on a trip. In a lot of times, you're best to wait till you save the full amount and then go do it all at once. And the idea of this is it's about either stopping yourself from just dipping into all of your savings that has had a very ambiguous purpose, or putting it onto your credit card, which more often than not a lot of people do. And then you're going to spend the next 3 to 6 months trying to pay it off. So use your buckets, put a name on them with a defined purpose, and then break it down into a monthly contribution to keep yourself on track.
Easy as.
Yeah.
All right, this is a question I get a lot. I had it this morning. What are some good investment opportunities? That's a very hard question to answer. There's heaps of good investment opportunities. Every day there's good investment opportunities, but it comes back to where you are today, what your means are, and what your goal is that you're trying to work towards. For anyone who's trying to create wealth, I think as a general answer, you need to invest in growth assets. Typically, that would be residential real estate or index funds in the share market. For other people that are a little bit more active, you can invest in your business and grow wealth through your business. But outside of those three asset classes, so stocks, property, and business, it's pretty hard to grow wealth,
especially in a low interest rate environment.
Yeah, correct. And who knows how long that's going to last for.
Yeah, and look, and I address this in chapter 7 of my book, which is Wealth Creation, where I've created some activities to help you go through a risk profile questionnaire and understand your tolerance to risk, and allow you to yourself to objectively select the right investments that you need in your portfolio to achieve your goals. So, shameless plug, go buy my book. If you bought the book, sign up to the portal. And then go, and once you've got to that point, when you get to wealth creation, go watch the videos there and complete the activities. I believe you get a lot of value out of it. It'll make it very clear of how you go about selecting investment opportunities, because a good investment opportunity can be often subjective, and there can be rose-tinted glasses depending on who's telling you about said good investment opportunity. If I listened to every good investment opportunity that I've ever been told,
you'd be broke.
I would be 100% well and truly broke, sleeping at Central Station. So you have to be careful. The way that you're careful is with a good education of being able to know when it sounds too good to be true, and how to select the right investments for your portfolio, following what we refer to as the wealth pyramid structure. Where we have 3 layers of our portfolio, which I cover in chapter 8 of my book, of being able to build a robust wealth journey that's going to set you up for your goals.
Yeah, and I'd like to articulate a little bit further on that. So what's a good investment opportunity to one person doesn't mean it's a good investment opportunity to the next person. So let's say for someone who's first starting out and they want to buy their first investment property, right? They're probably going to start small. They're going to buy maybe a house in a regional centre, or a unit or an apartment or a townhouse in a city somewhere. They're going to do something pretty basic, right? They're probably going to buy something that's already, in pretty good condition. They're not going to renovate it. They're not going to demolish. They're not going to develop. They're not going to do anything like that. So a pretty simple investment for someone starting out is probably going to be a good investment. Let's look at the full other side of that. Let's look at someone like Harry Triggerboff, right? He's building how many thousands of units in DY. For him to go out and just buy a unit or to buy a house, that would be a horrible investment for him. He needs to build thousands of units for him to make a return on his money, because he's worth billions.
A return on equity, right?
Correct. That's the compounding. For him to get those high percentage returns, he needs to build big projects. So for him to buy one of these, let's say a small unit, it wouldn't be worthwhile. For him to build these big towers that he builds, it's not risky for him, right? On the flip side, you go back to that beginning investor. For them to build a big tower, they're going to go broke 100%. 2 days in, they're going to run out of money. But that little unit to start off with, that's going to be a good investment for them. So it's really down to the individual more than the asset itself.
Yeah, don't try and build a skyscraper without solid foundations.
Very good.
All right, so I'm struggling to know my numbers in my business. What should I expect from a good accountant? Okay, so I'd expect that you're probably trying to chase your accountant to get access to the numbers, and you're probably questioning whether you're in the right place, which is a very common question that we get. Typically, there's two types of accountants. There are accountants that do things pretty much manually and do the bare minimum. Will help you lodge your BAS, do your compliance, such as your tax returns and your financial statements at the end of the year, and probably not a whole lot more than that. Besides giving you a pretty binder with historic documents that you probably chuck in a bottom drawer and never look at again. And a good accountant, somebody who is there to essentially act as a guide and an advisor in your business, should be proactive, and they should be assisting you to understand the metrics and I guess the characteristics in your business, and help you get active insights into what you should be doing to enhance the value of your business and buffer against risk. Typically, and one of the reasons why we've got this as a part of our first workshop, is that 9 out of 10 business owners that I speak to have cash flow problems. They typically don't understand where, I guess, the relationship between when they make a sale and when dollars hit the bank account, and they're not able to determine the consistency of their cash flow and the trends in their cash flow, even if they do have a seasonal business. So a good accountant or a good tax advisor or business advisor should utilize your financials in your business and the metrics in which you operate as the key measure for performance in the way that they interact with you. And of course, they should be commoditizing the process of doing all of your compliance and the things you're obligated to do as a business owner, but they shouldn't take priority. If your accountant is just driving all of the conversations by talking about your obligations, then you're either probably not on a high enough package to be able to warrant their advice, or they may not have the capabilities to provide you with that advice. So if those are the things that you're looking for, then you should be asking your accountant for them, and then obviously, depending on that conversation, gauging whether they're the right fit for your business.
Yeah, I'd like to give you guys a good example just with our business, right? So next Tuesday, I'm heading off into the city. I've got 2 meetings with our accountants. The first meeting is going to be our cash flow forecast for the next 12 months, right? So we're going to do the numbers. Not that we haven't done them, we've done them about 3 months ago, so we're going to do them again and look at what the growth of the business is going to look like. Once that's done, we've got our monthly meeting booked where we look back over the past 30 days. We look at all our cash flow between all the different entities, all different businesses, and we see, how much money's coming in, how much money's going out. We put that against what our forecast was, where the money's coming in, where the money's being spent, and that's going to give you really good ideas of which levers to pull to keep the business going in the direction that you want it to go in. And there's 2 things to take away from that. Number one, if you haven't done the budget forecast, right, so you don't have a strategy of where you want to get to, then it doesn't matter because you don't know where you're going. And 2, if you don't recheck against what budget forecast you've set for yourself, how will you know if you're going in the right direction, and how will you know how to steer the boat to get you back to the direction you're trying to go in? So these are things that, what would you say, 2%, 1-2% of businesses do, and it's you have to do it. There's no, you're not employed anymore. You're self-employed. You're running a business. You need to know these things,
and that's why less than 2% of all businesses last more than 10 years.
There you go.
It is really lack of understanding around how to effectively manage your cash flow to be able to scale and grow. So hopefully that makes sense. We've got the last question here.
All right, another property question. Okay, so I'm living at home with my parents and I want to buy my first property. How much deposit do I need to save? Look, this is a really common scenario. This is a very common scenario where young people can't afford to buy their first home and move out, so they buy an investment property first to get their feet on the ladder, and then they go from there. I've done it. I bought my first property when I was living at home with my grandparents. So how much of deposit do I need to save? Well, you've got 2 options, right? Last week we discussed the family guarantee option, which is essentially you don't really need a deposit, a cash deposit. If your parents own their own home or you have family that owns their own home, assuming that you can service the debt, you can borrow the deposit against their property, you can borrow the remaining 80% of the purchase price against the new property. So you end up borrowing about 105% of the purchase price, and you can go out and buy your first investment property that way. That's not what this question was asking. They were saying how much of a deposit do they need to save. Let's assume that for some reason or another they can't use a family guarantee. Maybe their parents don't want to, maybe their parents don't own a property, maybe their parents don't have enough equity in their property. It could be any number of reasons. Let's say a $500,000 property, okay? You would need these days, to save up about a 12% deposit, right? So 10% deposits were active for a long while. Banks have clamped down. You probably need about a 12% deposit these days, and you're going to have to put around away about 4.5% for stamp duty. So you're going to need about 16.5% of the value of that property. And at 500,000, let me do some quick maths here. Big shot. At 500,000 times 16.5%, you're going to need a cash deposit of about $82,000, give or take. All right, so that's sort of where you can aim for to buy a $500,000 property. If let's say that's too much, you didn't want to save up that much, let's drop it down to 400,000. Same rule, 16.5%, so about 12% deposit for the banks, about 4.5% for stamp duty costs, and you need to save up about $66,000 to buy a $400,000 property. So these are attainable figures, especially if you're living at home rent-free. These are really, really attainable figures. You should be able to save, I reckon, a majority of your income, because you don't have the living expenses, which is where most of our clients, most of their money goes every month in their budget, goes to their living expenses. What do you say, about 50%?
Yeah, but in saying that, I think that a lot of people will get scared by these numbers because they seem big when you're starting from not a whole lot. And the hardest part of your wealth journey will always be getting your first foot on the property ladder, because it's only your ability to save, or you and your partner's ability to save a deposit. You don't have compounding working on your side unless you're buying equities and those type of things with that money. But you need to understand, and I've said this on a number of occasions, people overestimate what they can achieve in a year and underestimate what they can do in 10. If it takes you 10 years to get into the property market, that is not a problem. You just need to continue to push on and have a strategy in mind for how long it's going to take you to achieve your goals. And you just need to ask yourself, are you willing to do what it takes to achieve this outcome? And it's essentially, it's as simple as that. You need to be able to defer gratification in pursuit of a heightened level of gratification for having the ability to own your own home. And I understand that in Sydney and Melbourne, this can seem unattainable. We're talking you might need $150,000 or $200,000 or $300,000 as a deposit just to get your foot on the ladder. Understand the stepping stones that you can use along the way to help you along the journey, and just don't be disheartened if it does take you a considerable amount of time to get there. You don't need to get there tomorrow. This is a marathon, not a sprint. Take your time, make the right decisions, take the least amount of risk in order to get to the outcomes that you want. And you'll do just fine.
Excellent stuff.
Yep, so another good round of Ask Aureus Anything Q&A. Once again, anyone who is jumping on here after we go offline, feel free to post your questions. We will chuck them on the list for next week. Be mindful that we're likely going to be shifting the time, so we're going to do a bit of research and just collate some feedback to work out what's the best time for everyone. And also, we have been getting our team to chop up these Ask Aureus Anythings into the questions and the answers into a more digestible format, which you can find on our YouTube page at Aureus Financial on YouTube. Further to that, if you want to come along to our small business workshop, feel free to click on the link, subscribe. We've got a limit to 24 seats, which is going to fill up pretty quickly. So looking forward to that. And we will catch you next week.
Next week.
Take care.
Thank you.
See you later.